The NASDAQ market is currently open, and Datavault AI Inc. stock, under the ticker DVLT, is trading live at $2.70, reflecting a steep decline of negative 16.46% in today's intraday session. This sharp move lower comes right after a significant period of immense volatility and parabolic gains that saw the stock climb over 200% recently, leading many investors to finally feel like the long-awaited payoff for this high-risk artificial intelligence and data play was materializing. The common narrative here, the expectation, is that a stock this volatile after such a run is simply experiencing a predictable, necessary correction, a quick profit-taking spree, or perhaps that the news from the past few days is finally being digested. Today's reality, however, is a little more complex and less benign than simple technical correction. It's a reaction to the delicate balancing act between rapid, aggressive corporate expansion and the corresponding need for capital, an action that is creating a liquidity event for the stock itself. Just a day or so ago, the company announced an acquisition, API Media, which is intended to expand their AI-driven data monetization capabilities into digital media and advertising. This news, which should be positive for long-term growth and recurring revenue, was immediately followed by an announcement of a stock offering, which is the key driver of today's drop. For a micro-cap company like Datavault AI, raising capital via a stock offering, effectively selling new shares, is a double-edged sword. It provides essential fuel for major growth initiatives and acquisitions, but it also dilutes the existing shareholder base, making each share a smaller piece of the pie. The market is reacting to this dilution fear, the short-term reality of more shares hitting the open market, and it's a direct challenge to the high expectation built from their recent success. The tension between expectation and reality with Datavault AI is a textbook case of a high-growth speculation in a white-hot sector like AI and data tokenization. The expectation is set by their technological potential and the rapid-fire string of positive headlines, the API Media acquisition, the licensing agreement for a carbon credit tokenization system, and the formation of major data unions in the insurance and accounting sectors. These moves suggest a company that is actively and successfully commercializing its patented technology, moving from a pure-play intellectual property firm to a scalable enterprise solution provider. This is the narrative that pushed the stock from its 52-week lows up to the $4 range. The reality, as reflected in the trading volume today, which is already substantially higher than the 30-day average, shows a significant number of shares changing hands, driven by the uncertainty of the offering and the fear of a discounted offering price. This isn't just retail panic. High-volume sell-offs like this often involve institutional investors or sophisticated traders shedding positions to protect gains or reevaluate the dilution impact. When you look at the recent trading range, the stock has been a wild ride, regaining compliance with the NASDAQ minimum bid price requirement only recently, a key technical hurdle that had to be overcome to maintain institutional access. This latest price action threatens to undo some of that stability. Investors who bought in a month ago, excited by the sheer potential of the technology, the way it aims to create secure, monetizable data assets using advanced algorithmic intelligence, or the use of interactive brokers to access these volatile assets, are now faced with the immediate consequence of funding that growth. The trading desk chatter around DVLT revolves less around the core business model today and more around liquidity and float. The total market capitalization, hovering in the hundreds of millions, means that even a relatively small stock offering can have an outsized impact on the share price. The company is in a massive growth phase. They have been expanding their infrastructure, moving headquarters, and targeting ambitious revenue guidance for next year. This kind of aggressive scaling requires massive capital, and for companies that are not yet cash flow positive, issuing equity is the most direct path. The expectation is growth. The reality is the cost of that growth. Contrast this with a titan like Apple stock, which generates cash in unimaginable quantities and can return capital to shareholders via buybacks and dividends without batting an eye. Datavault AI is at the opposite end of the spectrum, needing to extract capital from shareholders to fund its future. This difference in capital structure explains the difference in stock performance volatility. The short-term movement will be dominated by technical analysis and the specifics of the offering. Once the offering closes, the market will shift its focus back to execution. Can the new API media asset be successfully integrated? Will the new data union start generating measurable recurring revenue quickly enough to justify the current valuation and the recent dilution? That's the core investment thesis. That has not changed, but the entry point and the risk profile certainly have. When we consider the underlying business, Datavault AI is a data sciences technology company focused on tokenization and monetization of data assets using high-performance computing and proprietary software. Think of them as creating secure, verifiable digital twins of real-world assets or datasets, which can then be traded or licensed. Their patented technologies, like data value and data score, are what give them their edge, aiming to bring verifiable trust and value appraisal to non-traditional data. The initial business foundation was more in high-performance computing infrastructure and event management software, which is where they get some of their existing, albeit small, revenue. However, the future is clearly in data tokenization. This pivot, changing the company's name from its former identity, WISA Technologies, and moving aggressively into AI and blockchain-enabled solutions, is the expected narrative. They've recently signed a letter of intent to work with Wellgistics Health on a blockchain-enabled platform for prescription tracking, pharmacy chain. This is a massive trillion-dollar market, pharmaceutical supply chain, where their technology can provide essential proof and transparency. This is the potential, the excitement, and the expectation. But remember, these are still early-stage initiatives. The reality of converting a letter of intent into a material revenue stream is a long, arduous process in a regulated industry like healthcare. The recent surge in volume, even on a down day, signals significant institutional activity. Smart online investment strategists aren't just looking at the price. They are monitoring who is selling and who, if anyone, is quietly accumulating at these lower levels. The insider trading activity, which has seen some net selling in the last 6 months, must be acknowledged, though it's small in dollar terms. More importantly, the institutional picture shows a small number of firms adding shares, which is a bullish signal that contradicts the overall short-term price trend. These are the kinds of contrarian moves made by experienced investors who utilize Fidelity investments or their own individual brokerage accounts to take a long-term view. They might be looking at the projected sales growth. Analysts have forecast massive sales growth for the current fiscal year, though starting from a very low base, and focusing purely on execution over the next 2 years, treating today's dilution as a necessary cost of doing business. The true test for Datavault AI won't be in this quarter's numbers, but in the next few announcements concerning these large-scale partnerships. For investors who are self-directing their trades and perhaps using platforms like Robinhood for its ease of use or the more sophisticated features of the Fidelity trading platform, the key is to understand that a stock like DVLT is a speculative bet on technology adoption, not a steady-state growth stock like Nvidia stock or Tesla was in their early days. The risk profile is orders of magnitude higher. The entire AI sector, from big names to small, continues to attract enormous speculative capital, and Datavault AI benefits from this sector momentum. The company is positioning itself as an intellectual property fortress, with its global patent portfolio spanning multiple countries and covering core technologies for data tokenization and digital twins. This intellectual firepower is the fundamental expectation of value. However, the reality of patent enforcement and licensing monetization can be slow, costly, and unpredictable. The short-term news cycle has been a flurry of corporate actions, acquisitions, data unions, stock offerings, which suggest management is pedal to the metal on growth. But this rapid pace introduces operational risk. Successfully integrating API media, ensuring the new data unions provide quality, monetizable data, and, most importantly, managing the financial runway after this offering are all significant challenges. This is not the type of asset you want to rely on the simple algorithms of a Schwab Intelligent Portfolios or the SoFi Robo-Advisor. This is a situation demanding active fundamental research and a high-risk tolerance, the kind of conviction that drives a user of the Interactive Brokers trading platform. Looking ahead, the future outlook for Datavault AI is entirely dependent on converting its recent commercial agreements into concrete recurring revenue streams. The catalysts that could push the stock out of this consolidation phase and back into an upward trend are clear: a major contract announcement with one of the data union partners, a definitive financial projection for API Media's contribution, or, most powerfully, a successful first compliant trade on a regulated digital platform using their technology, potentially in Switzerland. This last point is crucial, as moving from potential to proven pipeline with institutional-grade compliance would fundamentally shift the reality of the business model. The primary risks, beyond the obvious dilution and volatility, are